Hello everyone, and welcome back to Econ IQ, where we dive daily into the depths of the world of money to help you expand your vision and find your own rhythm on your journey toward building wealth. We want you to outperform the competition. In today's video, I know that many of you feel as if you're on a roller coaster. It has been exhausting. Just 2 days ago, we were all celebrating gold breaking the level of $4,600 and silver reaching $90, as if it were a train moving at full speed with no stops, a feeling that financial freedom had finally become within reach. But what happened after that? We woke up to a completely different reality. The market slapped everyone with reality. Let's look at the charts. Gold prices pulled back strongly after that rise and dropped below the key psychological level of $4,600. Gold is now stabilizing near the $4,580 range, and to be fair, this is a relatively calm pullback. As for silver, that aristocrat gone wild among metals, it returned to show its untamed side once again. It was brutal. The volatility was terrifying, as silver dropped by more than 7% during the session, retreating toward $87. As for those who chased the top, you may find yourselves now stuck in a losing trade, and I know your confidence has been shaken. With this violent pullback, my inbox has been filled with messages over the past 48 hours. Many are asking, is this the top? Are we heading toward a crash to the bottom? Should I cut my losses and run? Slow down, everyone. Take a deep breath. There is no need to panic if you're losing sleep because of a decline that lasted only 2 days, or if you feel completely lost because you may be missing the full, real logic behind this move. This is not a collapse, it is a necessary liquidation. It is a cooling process for the market after a period of pure mania, a healthy reset before the next move. And today we will use this deep analytical video to cut through the noise and reveal the full truth behind this correction. We are not talking only about price numbers. We're talking about an unprecedented power struggle and a massive shift in capital that is happening right now on Wall Street. We will break down the Trump administration's war on the Federal Reserve and analyze why Wall Street is actually selling the United States in preparation for the big midterm deals known as Big Mac. Most importantly, in the second half of the video, I will explain why I am still optimistic about silver and why I believe it is a radical game changer for ordinary people. We will rely on hard data. We will cover the gold-to-silver ratio, industrial demand, and Wall Street's hidden agenda. And in the end, you will understand why I say this correction is not a reason for panic. All right, let's begin. First, we need to identify the source of all this anxiety in the market. Many believe it is merely profit-taking after a strong rally, but that is only the surface of the picture. The real reason is a massive power struggle at the highest levels of the American government. The tension between Trump and the Federal Reserve is no longer a secret, it is an open confrontation. This conflict raises what is known as the risk premium that global investors demand in exchange for holding U.S. assets, and this is extremely dangerous. It shakes the foundation on which American financial dominance is built. Ask yourself, why does the world pour its money into the United States? The answer is the credibility of the dollar and the independence of the Federal Reserve. Global investors trust that the Fed makes decisions based on data, inflation, and jobs, not politics. The Fed was not supposed to serve the agenda of any one president, but now that trust is eroding with Trump's public attack on Powell and the use of the Justice Department to investigate him. Big capital has begun to ask, if the Federal Reserve loses its independence and money printing becomes a political tool in the hands of the White House, can the dollar still be trusted? The uncertainty created by this political risk triggers a massive wave of capital flight. That is why we see sharp swings in bond yields and difficulty in stabilizing the stock market. This intervention creates a domino effect. Yields rise because people stop buying bonds, and stocks fall because the logic of fair value no longer works. All of this confirms one clear trade: sell the United States. But where does that money go after it exits U.S. assets? It is looking for a safe haven, a place with no political risk, no dependence on the mood of a president, and a track record that spans 5,000 years. Yes, you guessed it, gold. Look at the data. The data does not lie. Holdings of the largest gold fund in the world, SPDR Gold Trust, have been steadily rising. What does that tell you? It means that while retail traders are flailing in panic, smart money is voting with their portfolios. They buy the dips, abandon politically charged U.S. assets, and choose the safety of gold. That is why gold's appeal is only getting stronger. A short-term pullback will not stop this massive wave of institutional capital. This is a major cyclical shift in asset allocation, and it will not happen overnight. Now let's talk about the new playbook that Wall Street is quietly applying. They gave it an attractive name, Big Mac. No, not the burger, but an abbreviation for big midterms. The big midterm elections are coming. This refers to the political drama surrounding the 2026 midterms, and as the date approaches, Wall Street elites are preparing for a period of serious political upheaval. As we know, President Trump has an extremely unique style. Governing through social media showed the market exactly what unpredictability looks like. He has been firing off semi-political statements left and right, clearly aimed at giving Republicans an advantage and winning voters for votes before November. But these vote-winning moves caused chaos inside the market, to the point that some might call it catastrophic. Let's look at the details. First, the banks. Trump recently proposed on social media capping credit card interest at 10%. My friends, this is direct government intervention in the free market. It literally moves the cheese, and a big piece of cheese. Bank stocks immediately collapsed because their entire profit model suddenly became questionable. Then look at the defense sector. It is usually considered a safe option, isn't it? The president surprised everyone when he asked defense companies to stop paying dividends and redirect that liquidity into production instead. This may look good for national security, but it's a nightmare for shareholders who depend on those dividends. It crushed investment expectations and dealt a powerful blow to the sector. This political confusion has now become the main risk for 2026. It forces investors to recalculate in a market that was previously priced for perfection. Even if the major indexes like the S&P 500 look stable on the surface, don't be fooled. If you look under the hood at individual stocks, you'll find volatility exploding. Individual stock volatility has now become double the volatility of the index. There is a deep current of fear. Everyone is terrified that their stock will be the next target. Even giants like JP Morgan sounded the alarm. With the Fed under direct attack and unbalanced policies, U.S. stocks are heading for a rough ride. We are 42 weeks from the midterm elections, and this style of governance, Twitter style, makes sticking to traditional trading strategies impossible. What is the market's biggest fear? A surprise step from the White House targeting a specific sector and breaking the market's balance. Today, banks, tomorrow defense. Will technology or healthcare be next? No one knows. Social media posts may look like one-day ripples, but the fear is full-blown. Simply put, no investor wants to wake up and find that their portfolio has become the target of the flavor of the day attack. Watching a stock open down 5% or 10% is not investing, it is gambling. History shows that we should always be cautious during midterm election years. And with political risk reaching the red line, many professionals have started leaning pessimistic. JP Morgan's trading desk warned that U.S. stocks may lag in the near term, and with legal and political pressure on Powell rising, the risk premium for U.S. equities rises, meaning global markets could actually outperform the S&P 500 in 2026. So, in the era of Big Mac, this is an era of complete uncertainty. Where does money go when stocks and bonds become too hot? Here, the true value of gold returns to the spotlight. As we discussed earlier, major institutional investors are still surprisingly underallocated to gold. And with the triple threat of inflated stock valuations, political shifts, and political drama in the United States, gold remains the ultimate haven for big money seeking certainty and asset protection. These institutional funds are enormous, and if they move even a small fraction of their portfolios into gold, the upward pressure on prices will be massive. And away from U.S. political noise, we cannot ignore the gray geopolitical unicorn looming on the horizon. I want to return to the situation in Iran that we referred to earlier. The Middle East is quietly approaching an explosion point. Internal unrest in Iran, external sanctions, and friction between Israel and its neighbors are pushing the region toward the edge of the abyss. The Trump administration's maximum pressure campaign increases volatility, and if a major conflict erupts in the Middle East again, it will act as a huge rocket booster for gold. Investors will flee political uncertainty straight into war hedge assets, creating a double punch for prices. Now, after we covered the big picture and gold, let's move to the core of today's video, the part I'm more excited about: silver. The violent volatility in silver over the past 2 days scared many people. It fell by 7%, and some think the sky is falling. But from my point of view, this drop is a huge gift from market makers. Why am I very optimistic about silver, and why do I consider it more aggressive than gold and perhaps the best opportunity for the average person to build wealth? There is a very solid logic you need to hear. Let's look at a simple but powerful arithmetic matter. The gold-to-silver ratio tells us how many ounces of silver are needed to buy 1 ounce of gold. Let's calculate it. Gold is currently trading near $4,600. If the gold-to-silver ratio returns to its historical average of 50 to 1, then what should the price of silver be? Simply divide 4,600 by 50. Silver should be at $92. Currently, the ratio is at 52, which is close, but remember, 50 to 1 is only the long-term average. In the peaks of previous bull markets like 1980 or 2011, this ratio fell to an extreme level of 30 to 1, and in the distant past it even reached 15 to 1. If we see this ratio reach again the bull market peak at 30 to 1, what is the potential upside? Dividing $4,600 by 30 puts silver at $103. Think about what that means. Even if gold doesn't move a single centimeter from here and silver merely catches up to its valuation in a bull market, it has the capacity to almost double its price. If gold rises to $6,000, that is a strong gain of 30%. That is excellent for big funds seeking to preserve wealth, but it is not exactly life-changing for the average investor chasing big returns. But if silver really moves, we are talking about doubling or even tripling capital. That is why I always say gold protects the rich, but silver changes the lives of everyone else. Gold simply cannot keep up with the explosive nature of silver. On the fundamental side, silver has a deeper logic. It is a metal that gets consumed. Think about it. Where does gold go after it is mined? It often turns into bars or coins or jewelry, then it is stored in central bank vaults or your personal safe. Most of the gold mined throughout thousands of years still exists today. It is not consumed, it just moves from hand to hand or stays stored. But silver's story is completely different. Silver is known as the vitamins of industry. It is the most electrically conductive metal on Earth, without dispute. Think about solar panels, electric cars, AI chips, and fifth-generation towers, 5G. None of these technologies can work without silver. And as the world rushes toward carbon neutrality and solar power, silver demand is exploding. Did you know that one electric car uses more than double the amount of silver compared to a gasoline car? Solar panels are literally soldered with silver paste. And here is the problem. Once silver is used industrially, it is lost. Even though recycling is theoretically possible, the cost is often so high that it is not worth it. Most industrial silver disappears when products are dismantled. This creates a massive gap between supply and demand. On one hand, mining cannot keep up with demand. Why? Because about 75% of silver is extracted as a byproduct while searching for copper or lead or zinc. Miners simply cannot press a button to increase silver output alone. At the same time, industrial demand is rising at a huge pace. Solar cells, artificial intelligence, and green energy are the giant transitions of the coming decade, and the need for silver in them is non-negotiable. Combine this supply shortage with the flight from a weak dollar, and it becomes almost impossible for silver prices not to rise. Now, some may ask, if fundamentals are this strong, why is the price volatile? Why did it just crash? Look at the giant investment banks on Wall Street. You know them well. They hold huge short chart positions in silver futures contracts, meaning they are betting on a price decline. Why? First, it helps them keep prices low so they can buy physical metal gradually or exit their positions. Second, they work with industrial giants to keep raw material costs low. As long as silver stays cheap, technology and solar companies maintain high profit margins. But this suppression has a limit. You can print paper silver, endless contracts, but physical silver is limited. Once industrial demand reaches a critical point and exchange vaults begin to dry up, we witness the most exciting events in finance. As soon as silver breaks a psychological barrier like $50 previously or $80 recently, the rules of the game change. Institutions with massive short positions face margin calls, and to stop the bleeding of losses, they are forced to buy back silver at any price. This buying pushes the price up, which forces other sellers to panic and buy as well. And something like a mass rush happens, making the GameStop story look small by comparison. This time, it is not a confrontation between retail traders and institutions, but between industrial giants and global central banks over dwindling supplies of the metal. I'm not betting on silver, I'm calculating it by the numbers. This is a high-probability trade aligned with the course of history. As for the recent short pullback over 2 days, it's just smart money using the news to shake out weak hands. They want you to sell your bloody chips before the real squeeze begins. If you sell now, you are walking straight into their trap. When looking at the big picture, this volatility in gold and silver is nothing but a small dip inside a bull market. The deeper the dip, the higher the next jump. Fundamentals are not just good, they are better than ever. First, the independence of the Federal Reserve has come into question, which shakes the foundation on which the US dollar itself is built. Capital is exiting US assets at an accelerating pace, and this is a structural shift that is hard to reverse. At the same time as the 2026 midterm elections approach, the Big Mac trade enters the full execution phase and policy turmoil escalates. While U.S. equities look more fragile than ever, investors rush in search of safety. On top of that, major institutions are still underexposed to gold, leaving huge room to build new positions. This means a large wave of latent buying power. In addition, the Middle East is still a powder keg that can ignite a flight to safe havens at any moment. And finally, the supply-demand deficit in silver, alongside the return to the mean in the gold-to-silver ratio, gives the metals market enormous upside potential and strong offensive flexibility. With these fundamental engines available, gold is in an ideal position for a strong launch in the first quarter once this short pullback stabilizes. For us, as investors, the game plan is crystal clear. Do not let short-term noise confuse you. Do not panic just because silver dropped by 7%. In this climate, volatility is not a threat, It is an entry opportunity. This pullback is your golden ticket to enter, especially in silver. And if you are already in the market, stay on your path and keep your conviction strong, and do not let smart money push you out of your position. Resist the urge to overtrade or chase small, fast gains of the T+0 type, because if you sell now, the market may move so fast that you will not be able to get back in at these prices. 2026 is the year of hard assets. It is time for gold to shine, and it is time for silver to return strongly. And as always, a quick reminder, these are my personal opinions only. This analysis is based on an in-depth study of current market data, news trends, and economic logic to help you get past the noise. And it is not financial advice, so always make sure to do your own research. This is the end of today's episode. If this deep analysis helped calm your anxiety or gave you a new perspective, leave a comment below. I want to hear your opinion about the direction we are moving toward. And don't forget to like the video, subscribe to Econ IQ, and share it with your fellow traders. Stay steady, and we'll meet in the next video. Goodbye.